What does the relationship between lumber and gold tell us about the stock market? According to portfolio manager Michael Guyad, nearly every major crash, correction, and bear market has been preceded by weakness in lumber relative to gold. And he gives some examples in this thread: the 1987 stock market crash, 1990 bear market, 2002 tech bubble, followed by the bear market correction, Lehman Brothers, etc. And if you look at the charts for gold and for lumber futures over the last month, you can see that gold's gone up and lumber's gone down. So in the event Guyad's indicator here is correct, and we have no idea if it will be this time, let's look at a way you can hedge your stock market risk using the SPY ETF as a proxy for the market. So first thing we'll do is we'll look up the current price of SPY, which is $423.61. Then what we'll do is we'll take a dollar amount for our portfolio. Let's say it's $1 million for this example. And then we'll divide it by that share price for SPY, which we've already forgotten, $423.61. And that gives us 2,360 shares. So next thing we'll do is we'll open up the Portfolio Warmer iPhone app and we'll put in SPY for the symbol. And for shares owned, we'll remind ourselves 2360. We'll put in 2360. And then in the next field, we'll indicate how much we're willing to risk as far as a market drawdown. So let's say 21%, just to be fancy here. And we'll start with our default time to expiration, which goes at approximately 6 months. And here we're shown the optimal put options to hedge 2360 shares of SPY, roughly $1 million portfolio, against a greater than 21% decline by December 17th. And the cost here was $13,961, which was equal to 1.4% of position value, and that's calculated conservatively using the ask price of the puts. So in practice, probably would be less than that. But let's talk about how we can potentially lower that cost. One thing we can do is try to round up the number of shares to a round lot, so something divisible by 100. In this case, the closest round lot would be 2,400 shares instead of 2,360. So we tap the back button, 2,400, tap, and here that has lowered the hedging cost. Now it comes down to $12,360, or 1.22% of position value. Note too, the annualized cost here is 2.35% of position value. Another thing we can do to potentially lower the cost is experiment with different times to expiration. So this hedge expires on December 17th. What if we took one that expired, let's say, October 15th? And if we do that, the hedging cost comes down in dollar terms to $6,792, which that's not a surprise because we're hedging a shorter period of time. And the cost as a percentage of position value goes down too to 0.67%. But what's interesting is the annualized cost goes down too. Here it's 1.94%. And then for our default, it was 2.35% of position value. So something to consider if you're long the market and you're concerned that Michael Guyad's lumber versus gold indicator foretells a crash or a bear market in the near future.